It is 3 a.m. in a windowless Mississippi basement. The hum of CRT monitors cuts through the dead silence. A mid-level auditor named Cynthia Cooper is staring at a series of keystrokes that do not make sense. She is looking at a $3.8 billion lie. The money wasn't stolen. It wasn't hidden in offshore accounts. It was simply rewritten. You probably checked your 401k this morning. You saw a series of digital pulses on a glass screen, numbers that represent your future, your security, and the decades of sweat you've traded for a promise of rest. You trust those numbers because you have to. You assume that behind those digits lies a fortress of cold, hard math, and the watchful eyes of federal regulators. But here is the truth that keeps the architects of Wall Street awake at night. Those numbers are not physical laws. They are choices. And in the early days of the new millennium, one man decided to choose a radically different reality. You are paying for his choices today. Every time you see a compliance fee on your brokerage statement or navigate the labyrinthine red tape of the modern market, you are paying a liar's tax. It's a toll exacted by the ghost of a man named Bernie Ebbers. Let us open the case file on the WorldCom ledger and reveal the shadow behind the success. Bernie Ebbers didn't look like a financial predator. He wasn't Manhattan royalty. He was a former basketball coach and motel chain owner with a penchant for blue jeans, cowboy boots, and a slow, Canadian-born drawl. He operated out of Clinton, Mississippi. But Ebbers had a hunger that couldn't be satisfied by hospitality. In 1983, in a coffee shop called the Hippo, he and 3 partners sketched out a plan for a company called LDDS, Long Distance Discount Services. The strategy was simple, brutal, and effective. Buy small long-distance companies, stitch them together, and grow at any cost. By the mid-90s, LDDS became WorldCom, and the strategy shifted from aggressive growth to absolute gluttony. Ebbers wasn't building a company. He was building a vacuum. He swallowed 65 companies in 6 years. In 1998, he pulled off the unthinkable, acquiring MCI for $37 billion. To the outside world, WorldCom was the indestructible backbone of the internet revolution. It carried half of the world's digital traffic. Wall Street analysts sang his praises using mark-to-myth valuations, and the stock price soared to $64 a share. But inside the archive, the ink was already starting to run. By the year 2000, the dot-com fever was breaking. The infinite demand for bandwidth turned out to be a hallucination. The fiber optic cables WorldCom had laid across the ocean floor weren't carrying gold. They were carrying ghosts. Revenue began to flatline. For any other CEO, this would have been a moment for a difficult, humbling conversation with shareholders. But Bernie Ebbers couldn't afford a difficult conversation. He had borrowed $400 million against his own WorldCom stock to fund a personal empire of timberlands, ranches, and a yacht-building company. If the stock price fell, the banks would come for his throat. The margin call would execute, and his entire identity would be liquidated. He was backed into a corner, and a desperate man with a ledger is more dangerous than a bank robber with a gun. Bernie needed a miracle. he looked to his chief financial officer, Scott Sullivan. He needed Sullivan to find a way to make the bleeding look like a transfusion. They needed to bridge the gap between the grim reality of their operations and the glittering expectations of the market. The numbers were wrong, but not in a way anyone could see. Not yet. They didn't invent a new financial derivative. They didn't use a complex algorithm. The trap was set in the quiet clicks of a keyboard, waiting to be discovered by anyone who dared to look past the illusion. To understand how Bernie Ebbers and his CFO, Scott Sullivan, nearly broke the global financial system, you have to understand the difference between a cost and an investment. It sounds like a dry accounting distinction, the kind of corporate jargon that makes your eyes glaze over in a boardroom. But in the hands of a desperate executive, that distinction becomes a weapon of mass capital destruction. Think of your own household. Every month, you pay your electric bill. That is an operating expense. The money leaves your pocket. The lights stay on for 30 days, and that value is gone forever. It's the sheer cost of existing. Now, imagine you buy a new roof for your house. That is a capital expenditure. You've spent the money, yes, but you've traded cash for a tangible asset that will last 20 years. On your personal balance sheet, you aren't poorer. You've just moved your wealth from your checking account into the physical structure of your home. In 2001, WorldCom was drowning in electric bills, but it desperately wanted the world to think it was building a mansion. The electric bills in the telecom world were called line costs. These were the exorbitant fees WorldCom had to pay to rival networks, like AT&T or Verizon, to use their wires to carry WorldCom's data. By 2001, these costs were astronomical. WorldCom had signed aggressive take-or-pay contracts, betting that the internet would grow exponentially and forever. It didn't. They were paying for massive amounts of bandwidth that nobody was using. They were bleeding billions of dollars in cash every single quarter. If they had reported those costs honestly, the stock price would have plummeted. Bernie's personal loans would have been called. The empire would have turned to ash. So, Scott Sullivan and his hand-picked lieutenants in the accounting department decided to engage in financial engineering. They decided to cook the books. The mechanism was elegant in its brutality. It worked in 3 precise, devastating steps. First, the payment. WorldCom paid the billions of dollars it owed to other carriers for line costs. The cash actually left the building. That was real. Second, the reclassification. Here is where the fraud was born. In the dark corners of the general ledger, Sullivan ordered his team to capitalize these expenses. The entries didn't come with invoices. They came with whispered instructions. Doctor prepaid capacity. CR line cost expense. There was no contract. There was no newly built asset. Just a number, moved at 2:13 a.m. They pretended these monthly bills were actually long-term investments in their own network. Third, the illusion. By moving these billions from the income statement to the balance sheet, the expenses magically vanished. On paper, the company's profit margins stayed artificially high, and their phantom assets appeared to grow. Paper profits, real losses. Between 2001 and the first quarter of 2002, they buried $3.8 billion using this single trick. To give you a sense of the scale, $3.8 billion was enough to pay the annual salary of every single high school teacher in the state of California. It wasn't a rounding error. It was a continent of fiction. This wasn't just a typo. This was a systematic, top-down directive to lie to you, the retail investor. They did it because they knew that the watchdogs were sleeping. Their outside auditors, Arthur Andersen, the exact same firm that would later collapse alongside Enron, were essentially playing with the house edge, rubber stamping the books. Sullivan and Ebbers operated under the cynical assumption that if the lie was big enough, no one would dare to look at the math. But they forgot about the people in the basement. Enter Cynthia Cooper, the Vice President of Internal Audit. Cooper wasn't a corporate raider or a high-flying lawyer. She was a meticulous, unyielding accountant who noticed something was deeply wrong when she saw a $400 million reserve for bad debts mysteriously moved to artificially boost income. When she started asking questions, Scott Sullivan didn't give her answers. He gave her orders to stop. He told her the board had approved the entries. He told her she was wasting her time. But in the noir reality of corporate fraud, the truth is rarely found in the boardroom. It is found in the hours between midnight and 4 a.m. Cooper and her small team, Gene Morse and Glenn Smith, began a secret investigation. They worked dead of night to avoid detection, knowing that if they were caught, they'd be fired, blacklisted, and ruined. They used a specialized software tool to bypass the official reporting systems and dive directly into the journal entries, the raw, unedited DNA of the company's finances. In June 2002, Morse hit a digital vein. He found a series of massive, unexplained entries labeled prepaid capacity. There were no invoices to back them up. There were no contracts. There was just a command to move billions of dollars into a category where they didn't belong. The forensic evidence was undeniable. On the 17th of June 2002, Cooper confronted the audit committee. She showed them the raw ledger. She proved how a company that claimed to be printing money was actually hemorrhaging cash at a staggering rate of nearly $2 million an hour. The titan of telecom wasn't a powerhouse. It was a hollowed-out shell, kept upright only by the audacity of its architects and the silence of the ledgers. The smoke was clearing, and the gun was still warm in Scott Sullivan's hand. But as the world was about to find out, when a $100 billion company falls, it doesn't just hit the ground. It creates a vacuum that pulls everyone else down with it. On the 21st of July 2002, the mirage finally evaporated. WorldCom filed for Chapter 11 bankruptcy, a legal surrender that remains a catastrophic landmark in American history. It wasn't just a corporate failure, it was a tectonic shift. In a single afternoon, $180 billion in shareholder value, wealth that belonged to teachers, firefighters, and retirees, was wiped off the map. Complete capital destruction. It was as if every person in the city of Chicago woke up to find their bank accounts had been set on fire. For the 30,000 employees who were handed pink slips, the ledger wasn't just numbers. It was the mortgage payment, the college fund, and the health insurance that vanished overnight. They were the foot soldiers in Bernie's army, and they were left as the ultimate bag holders on a burning battlefield. But the real trial took place in a courtroom in Lower Manhattan in 2005. Bernie Ebbers sat at the defense table, his folksy coach persona replaced by the hollow stare of a man who had finally run out of clock. His defense was as audacious as his fraud. "I didn't know." He claimed he was a visionary, a big-picture guy who didn't understand the technicalities of the accounting. He tried to paint himself as a victim of his own CFO's dark brilliance. The jury didn't buy a word of it. They saw the $400 million in personal loans. They saw the motive. They saw that in the world of high finance, ignorance isn't a defense. It's a confession of gross negligence. On the 13th of July, 2005, Bernie Ebbers was sentenced to 25 years in federal prison. Scott Sullivan, the man who held the eraser, received 5 years after flipping and turning state's evidence. But the verdict didn't end with a prison sentence. It ended with a bill sent directly to you. In the wake of WorldCom, Congress passed the Sarbanes-Oxley Act. It mandated that CEOs personally sign off on financial statements, putting their freedom on the line for every decimal point. But safety has a price. Today, public companies spend billions on SOX compliance. You pay for Bernie's lies every time you buy a stock, every time you pay a banking fee. And if you think this kind of accounting fiction died in 2002, look at today's market. Companies that don't report real profits, only adjusted EBITDA. Tech giants hoarding AI chips and building massive server farms for a projected future that hasn't arrived, creating valuations based on mark-to-myth mathematics. Private firms worth billions that no public auditor has ever fully dissected. The tools changed. The incentives didn't. So here is the uncomfortable question. Did the Sarbanes-Oxley Act actually protect your retirement? Or did it just create a multi-billion-dollar compliance industry that suffocates American innovation while letting the real predators hide in plain sight? If Scott Sullivan worked on Wall Street today, do you think he'd be in prison or running a hedge fund? Tell me I'm wrong in the comments. As you look at your retirement account tonight, remember the WorldCom ledger. The system is more secure today, but it is also more cynical. We learned the hard way that a trillion-dollar empire can be brought down by a deliberate keystroke. The file is closed, but the ledger is never balanced. Keep your eyes on the margins and your hands on your wallet. Because in the ledger of history, every debt must eventually be paid.